Hello everybody, welcome. I'm going to walk you through an Excel example of the CAPM, simple CAPM model in Excel. And here we're just going to have the simple CAPM model. So we won't use the full three-factor Fama-French model or the four-factor, which will include the momentum factor there. Today we're just going to go simply through the simple CAPM model with just the market risk premium within there. So here's the Excel spreadsheet. You can see I've already downloaded some data. Okay, so I just downloaded this data from Yahoo Finance. So you can download from other data sources. Yahoo's free. Pretty easy to just download one single security into Excel. So if you don't know how to do that, I have some previous videos that you can go back and refresh yourself. So I've downloaded Tesla stock, TLSA, and I have daily data dating back to the beginning of 2015. So all the way back to 2015, we have about 692 observations. And so this is where we'll start. So really the first thing we should really try to do here is, because we need some additional data, such as the market risk premium and the risk-free rate, really a good source to go to obtain that quick and easy is we can go back to the Kenneth French website that stores the Fama-French factor data. So if you just go in and you simply Google Fama-French factors, you'll come up to a data site that looks like that. Here is the site itself. If we scroll down here you're going to see the Fama-French three factors, and you're going to have a couple different options: text or a CVS file. We'll click on a CVS file for daily data. We'll open this zip file up, and once we open this file, you're going to see that here are the factors that we're going to. We're not going to use all of these today. In a subsequent video, we're going to show you how to run this model with the small minus big, high minus low factors. But here's the data dating all the way back to 1926. I'm quickly going to sort this data just to correspond with our dates. Here you can see this is from oldest all the way down to newest. I want it the other way around, so I just sort it, and now I have 2017 09 29, which is going to correspond with our data that we have within our Tesla spreadsheet. So here what I'm going to do, all these metrics here are in basis points right now. Here what I'm going to do actually is I'm just going to take this data here and I'm going to divide them, scale it by 100 for it to correspond with our return measures that we're going to calculate for Tesla in the next spreadsheet. So we divide all these factors by 100, double click this, once you divide this by 100, you can just drag these across, okay, double click here, and it will do it for the entire spreadsheet, right? I'm not going to go all the way down there. And we did lose the headers when we sorted this. So this is actually the market return minus the risk-free rate. Okay, so that's your market risk premium. This is the SMB factor, and this is the high minus low. So one is a size factor, one is a value factor, and this is the risk-free rate. Okay, and so here's our data that we have. Remember, we only have data that's going back until the beginning of 2015. So I'm just going to drop this down to the beginning of 2015, and I'm going to copy and paste this over to our previous spreadsheet. So down we go. Here we are to 2015. It's down a little bit more. Here is our data that should match up. Okay. Copy this. I go back to the previous spreadsheet. I'm just going to paste this in here. Should have pasted it with values. Just paste values, because if you paste it the way I did the first time, it's not going to copy the formula over. So make sure you do paste with values here. Okay. Once you paste with values, everything will come in. So here we have all our factors. We actually don't really need the small minus big, the size factor, or the value factor. I'm going to leave it there for now, but you can erase those two guys if you don't like them on your Excel spreadsheet. So next, what we'll do is we have to calculate what the returns are now for Tesla. Okay, so the returns for Tesla, if you've watched any of my previous videos before, we know we're going to do the continuous compounding returns here, which is the natural log of today's price divided by yesterday's price. We hit enter. We see this is a daily return here for Tesla. We double click down, and this is going to drop our data all the way down to our last return measure. You can see the last return measure is going to have this hashtag div metric in there. We don't need that. We should delete that. This can cause you sometimes some problems in the future. And the reason why we don't have that is because we don't have a previous price return here, or price metric, right? The day before January 2nd, 2015. There's no data there previous to that, so we don't have data to calculate a return there. That's why we don't have that cell filled in. So now we have the returns for Tesla, but now we need the excess, okay, the excess returns for Tesla. So the excess returns for Tesla, what's the excess returns over the risk-free rate? So that's easy to do. We have the returns on Tesla here minus the risk-free rate over here. Enter. Now this is going to give us our excess return measures for Tesla, and we're going to need that for the CAPM model to calculate. So if we double click on that, down it goes. We see the excess returns for Tesla, and this should go all the way down to the bottom. Things look good there. All the cells are filled in. We have some positive, we have some negative returns. That's normal. But now what we're going to do is we're going to go, we have all the measures that we need. Remember the CAPM model, right? The CAPM model, if you look back in your book, the CAPM model is going to equal what? The excess return on the stock, okay, is going to equal to some alpha, which we're going to calculate, plus beta times by this risk premium factor, okay, and then you're going to have an error term somewhere on the end when we calculate that. And so to do this calculation, we can simply go into the data tab here. Once you're in the data tab, you can go over to data analysis. And once you're in data analysis, you should see this regression. Okay, if you don't see this regression here, it's because you haven't added in a package you need, the data analysis package you need in Excel. So if that is the case, you're going to if you don't have this here, you're going to have to go back to File, back to Options, and you're going to have to go to Add-ins and make sure you go within Add-ins, and you're going to have to go through here and make sure you add in the data analysis toolbar. So if that's not clicked, you're going to have to do that. But if you already done that, you're in good shape. Data analysis, regression. Once we go in here, it's going to ask you what the input ranges are for your values. Now, if you should have seen the CAPM model in your textbooks, in previous reviews, so you should know that the X, okay, the X range that we're looking for here is this range here, right? This is the excess return on Tesla, okay? This is the excess return measures we have on Tesla. So we have those excess returns. Now it's going to ask you for the X range, right? So that would be your independent variables. We know that your X range here, the X range here should be now this market risk premium. Okay, so we highlight the market risk premium. We drop this all the way down. We have both of our streams in, our X range, our Y range. Scroll back up to the top here. Now it's going to ask you, we have labels, right? We have some labels for our data series, so we have that clicked. And then it's going to ask you where you want to put your output. Okay, so where do I want to put my regression output? I want to put my regression output. It's going to start right here in cell J2. So I have all those in there. Once I hit OK, it's going to run the regression for us. And once we have the regression run, we're going to go through here and we're going to see some different types of statistical output that you should have also seen probably since previous classes, statistics, etc. So here we can see this is going to be our beta. Okay, so this is the market risk premium. This is the coefficient that goes along with the market risk premium. This right here is your beta. So Tesla, using data over the past close to 2 years, about 19-20 months worth of data, has a beta of approximately 1.20, which suggests that it's a little riskier than the general market. Okay, and this is going to be your alpha. Okay, so this is going to be your alpha. Now remember, the slope of the line, and if we look corresponds back to the book here a little bit, is the SML line, security market line, and the slope of that line is the expected return of the market minus the risk-free rate. Okay, and then the beta of 1 should correspond with the expected return of the market. So with this beta of 1.20, we should be expecting some sort of return in excess of what the market returned in positive market fluctuations, and hence negative, with the worst returns when the market is returning negatively in general, or on average. Okay, so here we can see, scroll back here we can see some additional statistics that come out. We have an R squared of approximately 17. Not so great in terms of R squared, but we only have one factor here. We add some more factors within this regression, that R squared probably gets much stronger. But that's a general example of conducting a CAPM, simple CAPM model in Excel. A good website. So a good website to go to, guys, is what referred to as Wolfram Alpha, and I'm going to sneak through here through my favorites pages. Okay, so if you go to this website, it's wolframsalpha.com, you can do a bunch of different things on here, and I'm going to let you kind of explore this on your own. But simply, if we type into the search box here, if we search Tesla beta, okay, Tesla beta, if we search within here, it's going to do some of its own calculations very quickly here, and simply it's done a lot of the calculations for us already. Okay, it's a pretty cool page. You can do, like I said, lots of different things. I'll let you explore by yourself, but here you can see that it's calculated beta, and so here it shows us the beta of 1.310 and an R squared of 0.11. A little bit off our calculation of beta, but it's using the last 5 years of data here. So let's just use the last 2 years. This should correspond a little bit closer to our data stream. And here you can see, look at, they've calculated a beta of 1.210 with an R squared of 0.130. So if we go back to our output here that we calculated, pretty close, right? We have a beta of 1.201, okay, and an R squared of approximately 17. Okay, so our data stream ends, you can see, on September 29th, and so our data isn't actually 2 years. It's a little bit off the 2-year scenario that Wolfram's Alpha used, right? But you can see this is going to provide you with some sort of context in terms of whether your beta is actually right here. So that's an example, guys, of using Excel to calculate beta, okay, and running a regression with the market risk premium here and the risk-free rate, and we've calculated the return and the excess returns for Tesla. So that's the session for today, guys. I'll cut it off there before we get over the 15-minute mark. So if you have any questions, you can throw it in the comment boxes below, or if you're in my class, you can email me and I can provide you with some more details. Thanks, guys.